In this presentation, we will enter an adjusting entry related to depreciation within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. To see our objective, we're going to go to the reports down on the left side, and we're going to select the report of the balance sheet. Within the balance sheet, we will scroll up top, changing those dates from 01/01/19 to 12/31/19. That's January through, let's make the second date 02/28/19, the cutoff date, the end of February, the date of our adjusting entries, and run that report. We're going to scroll down. We're concentrating in on the furniture and fixture, the equipment, the depreciable assets, the assets that are going to be property, plant, and equipment, those that we put on the books as an asset, and then we're going to depreciate them over time, lowering the asset over time as the asset goes down in value. In other words, we're going to deviate for the furniture and fixture from a cash basis. Typically, we're going to deviate from when we purchase the furniture and fixture, simply expensing it at the time of purchase, because we know that similar to the prepaid insurance, which was going to be beneficial to multiple periods in the future, the equipment that we purchase will also be beneficial. So this would be things like a forklift. This would be things that are large purchases for the office, that are going to be large pieces of the office equipment or the office furniture that are going to be lasting for long periods into the future. We don't want to just expense them when we purchase them for the same reason as with the prepaid insurance, because it'll distort the month in which we purchase. In other words, if we compare this $103,000, if we were to purchase that in this month, it would make our income statement look very small, even if we were to be using this equipment for multiple years into the future. And therefore, it would really distort if we were to purchase this with cash and expense it, or not cash. If we were just to purchase it, the cash isn't the driving factor, in other words. However we purchased it, even if we purchased it with cash, we wouldn't want to expense it on an accrual basis in the time of purchase, because it'll distort the financial statements. And you could see it most clearly with furniture and fixtures. In other words, even if we're on a cash basis, we will typically still deviate from that cash basis with relation to buying equipment, buying like a car or a forklift or large pieces of furniture, because we can see that will clearly distort the financial statement. So even if we're on a cash basis, we will typically deviate from it with regard to large purchases. So we have this large purchase here. We made the $103,000 of this large purchase, and it's on the books as furniture and fixture. We won't get into the different types of depreciation methods, but just note that depreciation methods basically are going to be some type of allocation over time. They're all basically based on what you would typically think of if you were just kind of mulling through this problem, and that would probably be some kind of straight line method. You'd say, okay, it's on the books at $103,000. I think it's going to last so many years, so let me just allocate the expense evenly over the amount of years that I expect to use this thing. So I'm going to just make up a number here. If we had this if it was one piece of equipment we had for $103,000, and we were going to say that we're going to use this for 10 years, we're going to divide it by 10. That means we should depreciate or allocate $10,300 per year. And then if we're dividing that out by per a month, an even amount per month, divided by 12 months, it would be $858. So that would be one way that we can allocate this out. It's much more complicated than that in practice, of course, because you can imagine that this piece of equipment, this account here, is going to involve multiple pieces of equipment that might be depreciated over multiple lifetimes. And we might use different methods than just simply a straight line. We might use some kind of accelerated method. So we won't get into all that detail, but the concept of it is fairly straightforward, and that is that we're going to put it on the books at cost as an asset, something we're going to consume and use in the future to help generate revenue. Then we will expense it or depreciate it over time in accordance with some type of estimate, some type of calculation. The other thing that's a little bit confusing, different than we saw on the prepaid insurance, where we just wrote down the prepaid insurance directly, is that we're going to have another account which we call accumulated depreciation. And the reason for that is basically, or we can think of it as, the original cost is what we purchased it for, And unlike something like the prepaid insurance, which isn't an estimate, we know exactly how much has expired, so we can write it down directly. As opposed to here, if this was like a forklift or something like that, we don't know exactly what the value is as of now because it's a unique thing. If we sold it on the market at this point in time, we don't know what we would get for it. So we're going to tell our reader, hey, this is what we purchased it for. This is what we think the decline in value is. And we're going to make up another account to do that so that we give our reader more information. We're going to say, hey, this is what we bought it for. This is what it's gone down by in accordance with our best guess, our best calculation, our straight line analysis, or whatever our depreciation calculation is. The difference between those two amounts is what we believe the book value currently is. We'll record the other side as what we call depreciation expense. So whenever you see depreciation expense, it's something related to property, plant, and equipment, something related to something like equipment. It could be depreciation on the car, on equipment, on furniture, something tangible that we're depreciation. So when we hear depreciation, it's really related to something tangible like that, a fixed asset, something that has long-lasting value. It really should be depreciation expense on something like a car, depreciation expense on the building, depreciation expense on the forklift, depreciation expense on the furniture and fixture. That's us allocating the decline in the value, expensing it in the period that we believe it's been consumed in accordance with the matching principle. So we're going to record that. Let's take a look at the income statement. And so we'll go up top and duplicate this. We'll right click and duplicate this tab. I'm going to pull the one from the left to the right so we have the balance sheet. Now we'll make the income statement or profit and loss with the reports tab on the left. Scrolling down to that profit and loss, we will change the dates up top from 01/01/19 to 02/28/19. That's January through February, our cutoff, the 28th of February, and run that report. We're going to want the expense down here. And again, the expense isn't going to be equipment expense or furniture expense. It's going to be depreciation expense. But we know that's going to be related to the equipment. And that again tells our reader, hey, this is an estimate. This is a depreciation. This is our best guess. So then we're going to go back up top and let's go ahead and make another tab. Right-clicking on this tab and duplicating it. Pulling the one from the left to the right. So now we have the balance sheet, the profit and loss, and the new tab. Typically, it's going to be an adjusting entry we would make with a journal entry, but there's only 2 accounts, so we could try to use the registers once again. So we'll go to the registers on the side. So here is our accounting. We want to be in the accounts. The 2 accounts will be depreciation expense and accumulated depreciation. We can't use the expense. We have to use a balance sheet account if we use the registers. So we're going to look for that accumulated depreciation. It's an order by type. It's an asset type account, although a contra asset. So here's the furniture and fixture. Here's the cost. Here's the depreciation. Accumulated depreciation is the account type. So we're going to go ahead and you'll see more what I mean by a contra account if you never heard that term as we record this. So we're going to go ahead and view the register. So this is accumulated depreciation. Now, again, it's a little confusing on the accumulated depreciation because it is an asset, but it's actually bringing down the cost. And that is why it's a contra account. So it's going to bring down the cost because remember what we're saying here. If we go to the balance sheet, we're going to say that we have the asset on the books here and then another account that's going to be bringing it down. So this is actually like a negative asset, a contra to the norm. So we're going to go back to the register and we're going to say we want a journal entry as of the cutoff 02/28/19, and it's going to be an adjusting entry, ADJ entry. I'm going to go ahead and copy that in case we need it later. And it's confusing to know if it's going to go up or down now because really the contra account is going up because it's a credit balance account which is increasing. But because it's a negative liability, QuickBooks may see it the other way. So this is one of those areas where we don't really know, and the debits and credits are actually better than the increase and decrease because in other words, the increase and decrease doesn't make things perfect or make it so we don't need debits and credits or make it easy to know which accounts are going up or down. So, but we can always use trial and error. So I'm just going to say, all right, 775 we'll put on the increase, see which way QuickBooks thinks that should go, if it should increase or decrease this account. And then if it goes the wrong way, we'll go back in and fix it. That's one of the nice things about QuickBooks. We can go in and adjust it. We'll go in and see if it does what it should do. If it doesn't, we'll fix it. So I'm going to say the other side then is going to go to depreciation. It's going to be an expense account. So it's already set up by the system. And there's the depreciation. It's going to be an expense account. So it's an expense. So we'll keep that. They put it into other expense, but we'll keep that there. So we'll save that. Also note that the amount we had, we just gave you the amount of $775. So that's going to be a calculation that we have. We're not going to go through how did we get to that number. We're not going to go through how do you calculate depreciation. You could use some type of straight line method, but that's a whole topic onto itself in terms of how do we track depreciation, how do we record depreciation. So this is just to record the adjusting entry once we've used some type of method like the straight line method to determine what the amount should be in terms of the decline in value for this time period and the related expense, which we're going to say is $775. So now let's go back to our report. So we're going to go to the balance sheet and run that report one more time, or once again at least. May not be the last time, probably will be though. And we go down to the furniture and fixture. We go down and we see the original cost. Now note, this is kind of a problem with the fact that we don't use account numbers. The original cost you would think would be on top, but because D starts before O, it's on the bottom. So you would think that it would be the 103, then minus the 775. In other words, hey reader of the financials, this is what we bought it for. This is the depreciation on it, which should technically be called accumulated depreciation on the balance sheet. So we're kind of deviating here within QuickBooks from the standard terminology, but this is a shorter term. So this is really accumulated depreciation if you think about normal terms. And note it went the wrong way though. It should be decreasing. So in debit and credit terms, this accumulated depreciation, a contra asset, would be going up in the credit direction, but QuickBooks sees it as an asset account going down. So that's okay. We can say, okay, QuickBooks wants to do it that way, so we'll go the other way. Notice now it's on a journal entry. So if I go back in, I'm going to adjust it. I'm going to fix it. I can't go back to the register. Now I could go back to the actual register, but now I'm just going to do it with journal entries. Here's the debit, here's the credit. Now from a debit and credit standpoint, I know that this is accumulated depreciation. It has a credit balance because it's a contra asset, and it goes up with a credit. So that's why the debits and credits are actually more clear. So this should be a credit then. And so we'll say 775, and the other side then is going to be a debit, 775 for the depreciation. So that's what's nice about QuickBooks. We can just go back in and say, okay, QuickBooks, we went the wrong way. It's our fault, not QuickBooks' fault, but we went the wrong way with it. We'll go back in, just reverse it, and we'll save and close. And now QuickBooks sees it as a negative. So if we go back, QuickBooks sees it as is recording it as a negative asset, which is kind of true because it's decreasing the asset account. It's going up for its account type, but it's decreasing the overall asset account. And so our reader is going to say, here's the 103,000 cost. Here's how much it's gone down by over the current lifetime, which is just a month so far. And that brings it down to the 102,225. So that's our book value. So note that rather than, as we did for the prepaid insurance, we wrote it down directly. This is done because we know exactly what that number should be. That's what's still left in prepaid insurance, no questions asked. Here, we don't know exactly what it is. We don't know exactly the value. This is our best guess. We're going to tell our reader it's a guess and what that guess is by giving them the cost and the related accumulated depreciation, the guess we made. And then on the other side, we'll go to the profit and loss. We'll go ahead and scroll up and run that report. And then if we scroll down, we'll see the depreciation down here. And again, this is depreciation expense. They put it into other expense, other income and expense down. I'm not sure that's where it should. I don't think it would. Personally, I would think it would not be in other expenses, but in the normal expenses. But that's what the chart of accounts that we set up within QuickBooks set it up as. So we may want to actually go back into that depreciation and adjust the account type to normal and have within the other expenses, just things that are kind of outside the norm. So I would actually just both of these, miscellaneous expense and the depreciation, out of the other category. And if you want to do that, you can go to the My Accounts, and go to Accounting, And then you want to go to those accounts. So you'll find those accounts. They're in order by type. So we would scroll down to the depreciation expense. So here's the expenses. We're looking for depreciation expense. So scrolling down, it's going to be an other expense. That's why it's down below. It's an other. Here's the depreciation. So we'll go over to the side where the drop down and say edit. I'm going to edit this one. Then within the edit field, we're going to change it from other expense to simply expense. And then save and close. And changing the type detail on the account may affect your accounting reporting. And we're going to say, yeah, that's okay. So we'll keep that there. And then we'll scroll back down. And the other one that we had was miscellaneous. So I would keep that under, it's a normal expense. We just didn't know where to put it, but I would say it's normal. So I'm going to say edit on that. And then we're going to just say that this should be an expense account. And save and close. And once again, yes. Then if we go back to our profit and loss, we go to reports. And if we go down to the profit and loss, which is our favorite report, one of them up top, and change the dates, 01/01/19 to 02/28/19, and run that report. Scrolling back down, now we don't have those two in the other, but rather in as a normal expense, which I think would be typically more appropriate. In other words, the things that I want in other down here are going to be those things that are kind of outside of the normal operations. Things that I want to get to operating income, which to me would be just normal type of operating income of our normal types of operations. Depreciation being included in those normal types of operations. And then look for those things that are kind of maybe outside, that are happen rarely. They happen not usually. And therefore we can't expect them to happen month to month. And so we don't want them to be a comparison. So this is the one that we should be able to compare the net operating income from month to month. Anything that's all outside of the normal operations that we don't want to include in the net normal operations, we can then put down below and still be affecting net income. But we can say, hey, that's something that I don't expect possibly to occur period over period, or for whatever reason, I don't think it should be in our normal kind of judgment about our operations or performance. You can see how depreciation you might think of that way, because I don't have control over the depreciation, but it is kind of part of our normal expenses during the operations. That's why I would apply it to a normal expense up top. For more accounting information and accounting courses, visit our website at accountinginstruction.info.